All right, everyone. Thanks a lot for joining another great webinar today. And we are joined by Brian Green and Rory Anderson from the Wind River Group. Um, Let me share my screen so that we can go through the obligatory disclosure and we can make the lawyers happy. One second. All right. Brian and Rory, can you see my screen? Not
Yeah,
yet.
it's just
It's just, all right,
Not yet.
perfect.
Oh,
yes,
now
there
I
we
can.
go.
Yes.
Perfect. All right. So, this is our disclosure. So, in case you're new to this webinar, as always, it's for educational purposes only. CamaPlan doesn't provide any education or it doesn't provide any investment advice or tax advice. When you are going to make any decisions related to investments or that will affect your taxes, we encourage you to do your own due diligence and seek the appropriate advice from those appropriate professionals. Another housekeeping issue is that we will have our chat off, so you won't be able to chat. However, the Q&A function will be on, so please be sure to ask questions during the presentation so that I can monitor those and share them with Brian and Rory. If you have any questions about self-directed IRAs or something that doesn't get answered during this conversation today, please don't hesitate to reach out to me directly. You can use the contact information that you see there, or you can just schedule a meeting with me and I'll help you out. And that is it. All right, beautiful. Here we go. I'm going to stop sharing my screen now and let you guys take it away. I think Rory
Awesome.
stepped away.
Yeah, I'll start. And Matt, let me know when you can see my screen.
I can see it.
Okay. Well, everyone attending, thank you. My name is Brian Green. Our group's based out of northern Utah. We're super thankful to be here. We highly recommend CamaPlan, and we're grateful for the opportunity. Just from an agenda standpoint, we thought it would be good just at a high level introduce our company and what we invest in. Secondly, just give you the lay of the land on why in multifamily rents have been flat and why it's been difficult to increase rents year over year. And then thirdly, Rory, our director of asset management, she will provide some examples and strategies that our group is implementing to increase operating income when you can't increase rents. So we're extremely thankful that you're with us today, and please ask questions as they arise. Just by way of introduction, these are our two principals. Mike Romney and Christian Thorne, they were partners in a pest control company. And this pest control company was in 32 different branches across 15 states. And they ended up growing this company to be one of the largest in the nation. And they founded this company on good principles, and they believed when good principles are taught that a company can grow. And so they ended up selling their company. But what's unique about this is they were investors as LPs in real estate for a number of years. And so they wanted to generate their wealth from their exit. And they took all what they've learned from being LPs and they created Wind River Group. And what's also unique about being in the pest control space is they knock doors in a number of states. And so we're very focused on location. And then secondly, very good operationally. And hopefully the takeaway is as you guys look at groups to invest in, you can learn from us and Rory on how to be operationally excellent in a market that we're in today. Um, this is our team. There's a team of 12. We have an acquisitions team and we have an asset management team. Most of us are from Utah, and I feel really blessed to be a part of this team. Just to give you a scope of what we've done thus far is we have over 88 investors. 30% of the $52 million that we've put into equity comes from Wind River. And we invest in 7 different markets. We own 700 plus doors, and we've distributed over $1 million to our investors. And we're super grateful for our investors and partners and where we're at as a company. To give you a lay of the land on why we invest in multifamily and why we think you should consider, invested in multifamily. What this slide shows is over when you look at a price per unit standpoint, apartments will always increase in value over time. And there's a term that will be used as you guys are looking at investing. It's called peak to peak. There are times when prices peak and there are times when they dip. But over the last 50 years, multifamily has been the most resilient asset. And so our group is really excited about the time right now because we're in the dip and we're trying to buy as many assets as we can. And we know through historical data that as you hold and buy at the dip, multifamily will always come back to peak and exceed. And so, what's also unique about multifamily right now is this darker blue line that shows nationwide what mortgage rates are and the cost to buy a home versus nationwide what rents are. Now, all markets are a little different, but we don't think we see this as an opportunity to be in markets, and we know that there is renter demand. It's hard for people to buy homes, and so what that has done for our group and our assets and other multifamily operators is if you're in a right market, you can have an occupied asset that's cash flowing. Now, what's interesting and what I'd like to talk about when I say pullback in nationwide multifamily deliveries, this chart is showing all of the new apartments that were built between 2000 and what's projected through 2031. And if you have invested in multifamily over the last 15 years, primarily in 2011 to 2021, there was a time when you bought an asset, the interest rates were low, so you could get a good deal, and it wasn't hard to increase rents year over year. And what happened as increase started to go, as interest rates started to even get lower, the cost to build really influenced developers to build a lot of apartments across certain markets and a lot of key markets that we invest in, and most of you have probably invested in. And so in 2022 to 2025, what that supply did is it caused owners of these assets to recalibrate. And it was really, really difficult to increase rents. And it's been difficult increasing rents. And that's the market that we're in. And the reason why is there's still a lot of supply. And what us as operators and owners are doing is we're prioritizing occupancy, and we're trying to maintain heads and beds and cash flow these assets, but it's been difficult increasing rents. And as you increase rents, you can increase NOI. And so what that kind of segues into, okay, for operators or owners that you're looking to partner with and invest in, how can you have confidence that you're going to get your monthly dividends and that you're going to partner with groups that can increase the value of these assets when we still have supply that needs to be absorbed? And so, what I'd like to just briefly introduce Rory, and she'll be talking about how groups like ours can be operationally excellent. And I'm going to stop sharing my screen because I know Rory wants to share hers. But I admire Rory. I've worked with Rory for a year and a half. She is a wonderful human being. She's one of the hardest working people I know. She's got 6 kids, and she is obsessed with increasing NOI and thinking like an investor and making sure that we're doing everything possible to manage these assets so that from an income and expense standpoint, we can increase value when we can't increase rents. And so Rory's going to be talking on some strategies that Wind River is implementing, and specifically her team. And so she comes from a great background. She studied at Cornell. She studied at Harvard. And I think you're going to really like what she says. And I would encourage you to ask questions while she's chatting. And Rory, hopefully that was a good introduction. And without further ado, Rory, take it away.
No, that's great. Thanks, Brian. Happy to be here and happy to answer your questions. I don't know the acumen of this group as far as real estate investment. So I'm going to say things, then hopefully I'm not dumbing this down too much, but I'm hoping that we can get to some of the things that we do in our group that will help you understand why it's so important to vet who you are working with in an investment type of scenario. So one of the things that, and can you guys see my screen okay? Okay, great. One of the things that we look at, I'm just going to talk about three things actually, that we look at when we're trying to increase value when you can't really increase rents right now. One is teaching the why. The next one is managing income and expenses, and then focused retention. So it's interesting. One of the biggest takeaways in my first couple years in the commercial real estate industry was that many property managers do not understand the importance of the numbers in their budgets. They get that they have to have a budget. They get that it's ideal to stay within that budget, but they often don't understand the why, which really surprised me. And here, you've got someone that doesn't have a college degree maybe or a finance background. They're running a multi-million dollar business and they don't really know how that business works necessarily. So as we onboard new properties and new managers, I always sit down with them and we talk about the why. I did this a few months ago with one of our managers, and we discussed how money flows into the property through rents and other income, and then how operating expenses work, and why it's important to know how much you're spending each month and which levers they can control and which levers they can't, because there's property taxes, there's insurance, like those costs they can't really control. We can help with finding the best insurance, right? But property taxes, you're not going to change. And then we discuss net operating income or NOI and why that's so important. And if you're new to CRE, I'll just quickly explain that NOI is how properties are valued in a way that equalizes the playing field. So NOI answers the question, how much income does this asset actually produce before ownership and financing decisions happen? And we would say that those are the below the line expenses. So here's where that invisible line lays right after NOI. After this line comes your mortgage payment, it comes your CapEx expenses and asset management fee, if there is one. And then what you get back to investors is this cash on cash, right? So I show him, I'm talking to him and I'm showing him what this net income line means and how every investor looks at that asset by its success below that line, that cash on cash return. And I give him some specific numbers. So I say, okay, I want you to hit this target here, this target here, this target here, and then this target here. And once he saw the flow of these specific numbers that we talked about, these targets that we were trying to hit for these categories, he just lit up and he was like, "Oh my gosh, I love this because now I know what the goal is. I understand how this business works and how it operates, and I understand what I need to get to make these numbers a reality." It was so interesting to me that this changed this new manager's way of thinking and completely took out all the ambiguity really for him. And that's really where operations meets ownership. Now, I did the same teaching scenario across all of our assets. And you know what was really interesting to me was all of the people I talked to told me the same thing. Even the professionals that I work with that have been in the industry for 25, 30 years, they all said to me that no ownership group had ever talked to them and explained their point of view of the asset. And I thought that was so interesting. So one of the things that we do at Wind River that is very important to all of us is that we can connect the people that are actually on the ground, managing the asset, managing the work, managing the inflow and outflow of expenses, to understanding the way their actions affect returns for investors. Because when everyone is aligned, we find that everybody wins in this scenario. So this net operating income, really, really important because this is how we value properties in CRE. This is the number that we often look at, but investors also like to see this cash on cash return, right? You want to make sure that the property's cash flowing. But that net operating income is so important because that is what is the value of the property is based on. So as we take over an asset, we want to see that NOI continually trending upward. To give you an
Rory, can I?
example, yeah, go ahead.
I was going to ask a question.
Yeah.
You might be about to answer it, but just out of curiosity, when you're talking to these different property managers, particularly the ones who are seasoned, and you're sort of saying, in the whole context of how their decisions affect the bottom line, basically,
Mhm.
and you
Mhm.
also separate the things where there's really no wiggle room, the costs are what they are, then there
Right.
are costs or aspects that they can control. On that other side of the things that they can control, were there any sort of like aha moments where people said, "Oh, I didn't realize like if I'm not paying attention to, custodial services or something like that, like the kind of like long-term effect it can have."
Yeah, absolutely. And I'm actually going to get into
Okay,
another process that we have as part of our ownership operations that I think often doesn't happen with many groups. So I'm going to explain that in a minute. But
perfect.
yes, absolutely. Most of the time, these property managers are given a budget. And they pretty much just see their budget. I have found instances where they haven't even seen their budget. They just kind of operate I would say blindly, and they don't really know. They don't really know what's happening because they have a regional manager maybe that's kind of overseeing the financial aspect, and they're just doing the day-to-day operations. So it kind of depends on which management company you're working with and what their SOPs are. And
Hmm.
that's something we'll talk about at the end. Like it's something that you want to vet and you want to be careful with when you're choosing an ownership group and you're watching who they choose for managers. We use all third-party management right now. And when we go into a market, I vet like crazy the people that we're going to be working with. And we have certain things that we do. And so I'll tell them like, if we hire you, this is how we're going to run things. This is how we're going to expect things to go. This is the cadence of communication that we expect. And so we kind of set the stage for what we want. That doesn't happen. There are a lot of ownership groups that are a set it and forget it type of group where maybe you have a syndication that they're just working on acquiring, and they kind of send it over to the third party managers and trust that they're doing everything right. And what I found is that that's not the best way to operate the business. It just isn't. There's a lot of great things about third party managers, and I love the people that we work with. However, teaching the business and finance acumen is not always it's not always second nature to them. So we have to kind of help go in and help them understand that why. So that's why this is such a key. I know it might sound strange that this is one of our guiding principles, but it really is.
Yeah, and I think it's interesting that like what makes a management company great might be measured entirely on experience, and experience is obviously very important. But in your case, having being sort of like coachable and directable is also very important, so that they're receptive to what you're trying to share with them.
Absolutely. Absolutely. And a lot of times I'll be on a meeting where you've got a regional manager, maybe you've got a VP of operations, and you've got the property manager. I'm trying to help teach the property manager some of the whys and the reasons why we're doing things. And what's been very interesting is to see sometimes a regional manager jump in and be like, "Oh wow, I didn't understand that either." So
Right.
good to know,
Yeah.
and that's where for me it's a little bit like, "Whoa, we like why are we not teaching this?" Like
Yeah.
we need to be teaching this. Um,
Industry-wide change sounds like it. You're a disruptor, basically.
Well, trying to be, I think, trying to
Cool.
be.
All right.
So, I just want to show you guys an example of this. So this is Austin. This is Austin's property. I want to show you what happened within a year's time. We went from we went to increasing revenue by 12% over 9 months. We were able to grow our NOI 19% from Q2 to Q3. We reduced expenses from 53% to 48%, and we were able to start distributions to our investors within 9 months of acquiring the property. Those are pretty crazy, phenomenal numbers when you think about the market that we're in right now. So that's just an example of why teaching the why is so important to me and to our investors into our group. Another thing I want to talk through is managing our income and expenses. So I when rent is stagnant, I am always thinking like, okay, how can we provide more value and options to our residents that they're willing to pay for? Because there are things that we can add to a property that maybe we have or we have in our CapEx budget that would be great things that people will want. So these are some of the things I ask as we talk about business strategy. What do my customers or my residents need or want? And one thing that's really important to understand is that every property is its own business. Every property, what works on one property is not necessarily going to work on another property. What's going to be the cost? How much is this thing going to cost me to build or to make or to provide for my residents? And what's the benefit going to be? So not only benefit to the residents, but is it something that I can charge for? And is it something that's going to increase my NOI? And then can I execute the plan? You got to know your property. You got to know city code. You got to know entitlements. So there's certain things. I've been on projects where we wanted to rebuild something or we wanted to add an amenity to the property. And then, as we go through the process and we get contractors out there and we get city people out there, we're like, oh, this isn't going to work. This is in a historical district. And so these are there's certain specifications we can't do. So not everything will work. You got to kind of try it out. You got to figure it out, right? So as we go through these things, though, what I like to think about is, okay, what are some things though that these residents really would like? Maybe you've got like a property in Aspen, Colorado, right? And it snows 6 to 7 months out of the year. Your residents are most likely going to be willing to pay extra to park in a covered parking spot, right? Because it's so much more convenient. Or maybe you've got a situation where you've got some larger common areas that don't ever get used. Could you perhaps divide that space into dedicated working space and they could have like the people that work from home, they could have some space to work instead of being in their apartment all day. So when we look at a new property and we try to think about the demographic, what are they going to want? What are they going to need? And we also do surveys sometimes where we'll ask the residents, like, what do you want? What are things that you wish you had at this property? We also look at our market comps. That's a huge part of shopping the industry. When we go into a market, one of the things I like to do the most is we'll go to the asset that we're planning to buy, but then I want to see all of the other assets in the area. As a customer, if I was coming in and I was moving to, let's say, Salt Lake City, I'm moving to Salt Lake City. I want to see what all my options are. So I always have to be thinking like a resident. I have to be thinking like somebody that's also looking for an apartment because just like when you go to the grocery store and you're looking at this barbecue sauce versus this barbecue sauce, right? Like you have to be thinking about why would a customer want to live here? Why would a resident want to buy this space for themselves? These are big decisions, and this is a major part of their income, right? They're going to be spending on rent. So we always have to be thinking about how can we present this property or this asset in a way that makes people want to live here. Another thing that we look at as far as increasing NOI is smart renovations. Now, what makes a smart renovation? Well, in some markets, it doesn't make sense to go all out for renovations because every property is different. Like I said, every property has its own target market and demographic. So what works for one property will not necessarily work for another. And you've got to know your market. For instance, we've got one 1970s property in a suburb of Nashville, and we are doing some renovations there, but we would not choose to do like new countertops, new cabinets, because we just wouldn't be able to increase the rents and get the leasing traffic and the lift that we need to stay occupied there because those residents don't really care about countertops and cabinets. They care more about flooring. They actually want no carpet. They want just LVP, nice flooring. So we can save money and on higher priced items like a cabinetry or a countertop and good traffic based on our flooring changes on that property. Now, sometimes owners will say, okay, we're going to go in and we're going to renovate 25% of units across the board and see if we can get an increase in pop that we want in rents. And in this slower part of the market, I would argue that where NOI is really being challenged right now, we find it better to test out a few units at a time and see if we're able to rent them and get the rents up in that we want in order to justify the expense of renovation. So we have tried that at one of our properties that is only about 20 minutes away from the property I was just telling you about in Nashville. And I told you, like, we wouldn't change countertops and cabinetry there. Well, at this property, 20 minutes away, same vintage, 1970s, we decided to pilot a reno program there. We felt like the market could handle it. So we decided to do, full renovation of kitchens, bathrooms, countertops, flooring, cabinets. And there we've actually seen an increase of $200 a month on our renovated units. So we've chosen to renovate these classic units when they come up. If somebody's moving out, we're not gonna release 25% of our residents and let them go. Instead, we're just slowly, as they come up, we'll take a classic unit if someone moves out of it, and we'll renovate it. And then next time we rent it, we're getting an increase. And sometimes that increases up to $400 a month, because if you have a resident that's lived there for 8 years and maybe the rents haven't increased as high as would want to in the market, then you see that switch over and that lease trade out becomes a lot higher after you renovate. So I like to think of all these small decisions that we make every day that add up to much bigger returns eventually. As we talk about, so that's kind of increasing the income side of things. As we talk about increasing or increasing visibility, I would say, into expenses. Our favorite our favorite line here, and this comes from our CFO Mason, who we love. He always says there's two ways to make more money. You can increase income or you can decrease expensive. But when you do both, it's magic. So I want to talk about expenses and what we do. For every property that we own, every single month, I do a line-by-line analysis of our general ledger. And I do this for a couple of reasons. First, I told you every property is different, right? Different vendor relationships, different turn costs, different problem areas. Seeing where the money is being spent helps me to learn the property better. And it allows me to get into the weeds. And as we like to say, the devil is in the details, but I would attest to the fact that the savings are in the details. So the other reason why I like to do this is many ownership groups I've talked about hire a third-party manager, right? And they just trust that they're making the best decisions for the property, the set it and forget it type of mentality. I have found that to be false. Sometimes the accounting team will make mistakes. Sometimes the property manager will buy things that really don't need to be bought to operate the property. And sometimes they're just not aware of the money that is coming out of their doors. For instance, this is a screenshot of one of the latest analyses I did on a property where we are paying for vacant, empty apartment utility costs. And notice that there's a varying degree of cost for these utilities. This property happens to be located in a very warm place in the desert, and the air conditioners had started to kick on. And obviously, we don't want the ACs running all day and night in an empty unit. So after showing the management team this analysis and talking through it with them, they were like, "Oh, we didn't realize that we had so much money leaving us due to utility costs." So they made an SOP for making sure that the thermostats were turned down to a respectable level when a resident left. The next month, the bill was cut in half. So doing this really helps our teams and our property managers to think like an owner. If you were personally responsible for paying that bill, what would you do? Would you keep the lights on or in the thermostat down so that the AC was running all day and night, or would you want to save that money? Right? We're always trying to teach them to think like an owner. So looking at the GL, doing this little exercise takes me about maybe an hour per property every month. But that 1 hour that I spend digging into the weeds can be the difference between hundreds and sometimes thousands of dollars of saved expenses. So that's another thing that we like to do. Brian talked a little bit about occupancy and renewals. This is something that we track heavily, and it's something that most ownership groups track. We are always looking at, okay, what's the submarket occupancy? Submarket meaning, okay, in the area right around my property, maybe a 5-mile radius, maybe it could even be a 2-mile radius. What is that submarket looking like? Because that tells me right there how much, how many people are in the area and what the market is willing to absorb. If there's one thing that we always say, it's that occupancy is king. And let me show you why. At one of our properties, when we took over from previous ownership, we started out with pretty dismal rates. So you can see down here, September 2024, we were down here in the 80s, low 80s. And as we went throughout the year, we were able to get occupancy up. And I like to see if we're beating that sub-market occupancy because that tells me our pricing is working and our marketing is working. I know if there's more people coming in that we're doing something right better than everybody else that's down here. Now, maintaining occupancy is a lot easier if you're able to retain residents. The national average for renewals is about 50%. So depending on the month, it just depends, but sometimes we'll even see like 100% renewal rate. But that's very, very rare. Most of the time, when it all shakes out over the year, you're going to see about a 50% renewal rate. Why does this matter? And I just put on here, we had a property last month that renewed at 87%. And it's one of our best performing properties, honestly. And it's because they're so good at retention. So let me show you why though. When we look at move out costs, when a resident moves out, there is more than just the cost of turning the unit. And turn is a term we use to describe the process of getting the unit ready for a new resident. So this list I have for you here breaks down all the ways a property might lose money if a resident decides to leave. So I broke this down to show what you might reasonably expect your cost of turnover to be for a typical, like let's say Class B multifamily property. Most operators today budget between like $4,500 to $6,000 per turnover as a realistic all-in cost. So for analysis purposes today, I'm going to just use the number of $5,000 per move out. And you can see here's all the ways that you might lose money. Now, I will say this too. Property managers do not think of their all-in cost. They usually think of turn costs being this right here, just the make ready, the paint, the cleaning, the repairs that need to happen. That's usually all they really think about. They might think a little bit about vacancy, but putting a number to that is hard for them to think about because they're not thinking of a day-by-day cost of like if I don't have this unit rented today, how much money is that costing me? So most of them just think about this. But I think about, okay, we've got vacancy loss. We've got if I have to pay somebody another leasing commission or bonus to rent this apartment again, if I have to advertise this apartment again, if I have to give concessions to a new resident because this is a difficult market, I'm going to lose money there. Utilities during vacancy, we just talked about. Any administrative costs, processing, and bad debt or skip risk. So when I think about that, that's a big chunk of money, of NOI that's being taken out of my property for every person that moves out. Now, let's say you have a 100-unit property. Let's say your average rent's $1,500 a month. We're going to use that $5,000 a unit, so that middle mark. Let's just pretend occupancy remains stable. So every person that you get out, you can put in. Like you're going to be fine with that, right? Only the retention changes in this model. So let's see what happens. If I retain 50% of my residents, so I've got 50% or 50 residents that renew, 50 that move out. My turnover cost is about 50 times that $5,000 average, which is about $250,000 annually, right? If I just save out of those 50 residents, if I just save 5 more and I increase my retention to 55% that year, I just saved myself $25,000 of NOI cost. Now, let's just say I bump it up to 60 residents. Now I've saved myself $50,000 annually. When I actually just showed this to to a property manager yesterday. No, it was 2 days ago. And we were on our weekly meeting and I was just kind of explaining this. And she was newer to the industry, but not that new. Like she's been in the industry for a while. And I asked her if anyone had ever shown her this, and she was like, "No, I had no idea." She said, I'm just gonna go gangbusters on trying to save every single person I can. Like seeing that amount of money, that is crazy, you know? So it was really fun to see her excitement and enthusiasm after we talked about this. But the reason why this is so important is because if you go from 50% retention to 60%, just that 10% difference. So you're still losing 40 out of every 100 residents, right? That NOI improvement is $50,000. But when you divide it by your cap rate, which is how we value properties in the commercial real estate world, that equals almost $1 million in asset value. So think about that year over year, saving that amount of money and increasing the value of your asset. That's where it is so important to understand that just because you can't raise rents doesn't mean you cannot create value for your property. I always like to say that the least expensive customer acquisition is the one you already have. So why aren't we spending more time with the people that we have and making sure we're nurturing them, making sure that we're doing things that make them want to stay at the property? And that's one of the things we really believe at Wind River is we're creating homes and places for people. It's not just about the money. It is a business. So yes, we are a for-profit business and we have to make sure that we're doing things right by our investors, but we're also providing homes for people. And that's an important part of our core values. We believe in having extreme ownership, taking responsibility for our actions. We believe in stewardship, and that is a huge part of who we are. So, hopefully, I hope this has been helpful to you guys to understand a little bit more about how Wind River operates, and excited to hear if you have any questions.
Yeah, and I thank you, Rory. We put this slide on at the end, not knowing if some of you are new to learning about syndications or whether you ever work with Wind River or any group. On the top left, that's what a general partner does. They find opportunities, they vet opportunities, they manage the asset, and they sell it. And then the limited partner gets to benefit from the things at the top left or bottom left, which is cash flow, depreciation, and then appreciation. But I think for this group, more importantly, is on the right hand side. I asked Rory, what are some questions a potential investor should ask a group like ours if they want to learn if they're good at asset management? And so, whether that's how they communicate good or bad news, I think this is really important. How often do they have standing meetings? Rory, how often are you meeting with the property manager and the regional manager of our third party property managers?
Yeah, it's a good question. So I meet weekly with our most of our properties. We have one property that I would say has been stabilized for a long time. It's doing really well, and I the meetings for that property are twice monthly. So it depends on the stage of the asset and where how good I feel like the momentum is there. But yeah, that's a huge part of our success.
Awesome. And then one thing that I've noticed is Rory's often traveling. I mean, we have assets in Tennessee, Kentucky, Utah, Montana. I mean, Rory's always on site, boots on the ground. So ask how often are the asset managers of that group on site. I think something that's really important in what I have observed is how often Rory, our asset manager, director of asset managers, meeting with the CFO. Just having that collaboration, being at the hip, making sure our group's financially sound, but also thinking about the investor is important. And then, Rory, do you want to mention
Yeah.
how do you manage below the line expenses?
Yeah. So one of the things that we always look at when we're vetting a property is we look at their NOI, but people can artificially inflate the NOI. And they do that by putting some of the operational expenses below the line. So I talked about that kind of below the line before that cash on cash return happens. Those are expenses like AC units, furnaces, carpeting, anything that's considered like a capital expense. And sometimes property managers will feel like, oh, that's not hitting my NOI, so I don't really have to pay attention to it, and I don't really have control over it. I've actually heard a property manager say that. And I'm like, no, 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 no. That that money is being spent at the property, and that money directly affects how much my investors get. So that's not play money. So how they manage below the line expenses, I would say, what are they doing to make sure that their managers are still staying within a budget? That's something that we always account for when we do our budgets, is we make sure that the below the line expenses, those larger items, appliances, like I said, water heaters, things like that, they still should be staying within a budget for those expenses. And that's really important to track.
We
Awesome. And
did.
then,
We had
oh, go
one.
ahead.
We had one question, and it's more just asking for contact information. So this person said, "What is your contact information, Rory? I would love to connect and learn more for my own services."
Yeah, absolutely. You can find our information on our website, but if you want just my email, it's Rory, Rory, at thewindrivergroup.com. Really simple.
I'll type that in right now.
Thanks, Brian.
windrivergroup.com. Rory at the windrivergroup.com. Send.
Nice.
Um, One other question that I came to mind as I was listening to Rory as well is another question we didn't add in here, but when you're looking at a group, asking if they have existing assets, asking the question, what is their renewal rates? National average is 50%. If they're below that, if they're above that, it should give you a good idea. That's probably a quick question to know if the groups you're investing in are managing these assets appropriately and being strategic with their budgets, and they're building good communities.
That's a good one.
As when you're talking to LPs and you're explaining kind of the Wind River approach, and you're going through this like um, very diligent attention to detail, and all the things you do, but particularly in what you just described, how how often do you find that this is kind of this is also new information to the LP that maybe they weren't even thinking before? And how many LPs do you run into who are LPs in other deals that for whom this information is also new, that they weren't thinking about this already?
Yeah, I can take. Roy, do you want to take a stab?
No,
Right.
I think you're a better person to take this one.
Well, one of my roles is building relationships with LPs, and oftentimes I'll ask, well, how do you differentiate? And I would say Wind River, there's three core things. Us as human beings and the principles we try to live by and run our business by, it really matters. People invest in people is what we've learned. Two is the location you buy in at the price you buy it. And that's a differentiator. But when LPs ask, how do you, when I answer the question, I kind of anchor on what you're saying, Matt, is the asset management side. And I love introducing people to Rory and the team. I love sharing information about how we're obsessed about asset management and finding and adding value when you can increase rents. And so I can't answer like how that necessarily compares to their experience with other groups like ours, but I will say the way we share information and the way that we get into the details, I don't think there's a lot of groups like ours that have an asset like Rory that can go in and implement the strategies that she's talking about. So I do think they're surprised when we provide the information that we do when they do invest with us. I mean, it's a monthly packet. They can see everything. We talk about the good. We talk about what we're working on. So I don't know if that answers your question, Matt, but
Yeah, that's really helpful.
yeah.
Another question I had is, uh, like I know you gave the example of covered parking in Colorado, for example. So, um, you guys aren't doing, you're not doing development, you're not building ground up property, you're not doing ground up construction, you're buying existing properties. Can you talk a little bit about the vintage that you buy and sort of like the largest amount of capex you'll do on a property?
Well, we have a few assets that are older. We've found and some of them have worked out really well for us, as far as they're all cash flowing and doing well that way. What I would say is we're finding now, it's better to buy assets that are a little bit newer if you can find them at the right basis, because there's just a lot less expense management that has to be done. There's a lot less turnover and the cost of turnover is less. So we're finding some really good things about that. When it comes to CapEx, we we look at every property. When we first go, my first thing when I go on the ground is like, okay, what are things here, and I talk to the property manager usually there when I'm there the first time and say, like, what do your residents say that they would love to have? What are things that you wish you had at this property that would make it easy? Because most property managers have been to dozens of properties. They've worked on dozens of sites. So often they're the best information givers. So often I ask them those kind of things. And then I think about, okay, what would your clientele want to pay for? Like, what would they be willing to pay extra for? Sometimes it could be valet trash. Sometimes it could be like the covered parking scenario, or just even reserved parking spaces, things like that, depending on, it's just everything is so nuanced in this industry. And I think that's what I've learned over my career is that you just can't go in and be like, we're going to do this, this, and this. Because until you really know the asset and the area and the demographic, you don't know what they're really going to be willing to pay for. So it's important to learn that. And as we grow and as we bring on more assets, that's something that we really hone in on. I also wanted to say, I don't know if Brian mentioned this at the beginning, but our website, thewindrivergroup.com, there are some great short videos, like YouTube videos on there that you can go on and watch that just explain about our underwriting process, explain about our asset management, our due diligence process, some of those things that are, I think, really helpful to understanding about a group like ours, especially. I get it. Like as an investor, I've invested in things that haven't gone well. And I've invested in things that have gone well. And it's important to me, like Brian said, to know the people that I'm doing business with, to know their values, to understand who they are. So I would encourage you to go out and check out what our core values are. Um, and just as a side note, I don't know if there's any operators on here, but it sounded like somebody might be one. I actually started a podcast because I found the need in this industry of asset management, of needing to supply the people that are on the ground, boots on the ground doing this job, they need more training. They need more information. So it's kind of out of the box to have an ownership group do something like that. But the podcast is called The Property Playbook. You can find it on Apple and Spotify. It's not, we don't make any money off of it. It's just a resource for people. And I think that's also been helpful for me. And in learning about how operators think, and hopefully helpful to the people on the ground.
Awesome. And I'm typing some of this up. I'm going to send it to the group via the chat because I can send chats. So it's called The Property Playbook, and it's on Apple and Spotify only.
No, I think it's also on Amazon and
Okay.
iHeartRadio.
Okay, cool.
But anyway, it's out there. It's an orange logo, orange and black logo.
All right. Cool. We don't have any other questions, but if you have any kind of closing comments, anything else you'd like to add, and we'll wrap things up.
No, I just thank you, Matt, for the opportunity, and thank you all for listening. If there's an interest in learning more about our services, I provided Rory's email. Mine's bgreen at thewindrivergroup.com, or you can find us both on LinkedIn. So thank you, Matt, and hope you guys all have a great day.
Beautiful. And like I said, I'm typing this stuff as I'm trying to do two things at once. Um, cool. So I just chatted both of your email addresses in the chat for anyone to check you out. And then this is being recorded right now, so we'll share the recording of this presentation to everyone who's attending and who registered. I want to thank you a lot, Brian and Rory, both for presenting today. This is really, really great information. I thought it was I thought it was magical the way you showed how a 10% change in renewal leads to basically $1 million of property value. That's very, very powerful. It's amazing. So thank you very much for that. Um, Everyone else, thanks for attending today's webinar. I really appreciate it. We will not have a webinar next week, but we should be back at it the following week. So we'll see you on that one. And other than that, have a great week, everyone. We'll see you on the next time. Bye bye.
Thank you. See ya.
Thanks.